Hey everyone, I'm so excited to introduce to you our monthly market update. Each month, we will give you an overview of what is going on in the markets. In this day and age, there is so much information being put in front of you. We want to make sure that you can hear from your financial advisor what you should really be paying attention to. However, any specific investments or recommendations will not be included because, as you know, we always consider what is best for you personally. So we're not going to make any blanket recommendations. So without further ado, welcome to the monthly market update. As we turn the page to 2025, let's take a look at what shaped the markets in 2024 and explain the key themes for this year and what it might mean for your portfolio. The U.S. stock market led global gains with the S&P 500 soaring 25%. In this graph, you will see the different sectors that make up the S&P 500. Growth stocks and tech giants like Nvidia, Tesla, and Meta drove the U.S. rally. For this next part, you need to understand the difference between small cap, mid cap, and large cap. The differences between the type of company that would be small, mid, or large is their market valuation. In order to be considered large cap, you have to have a market valuation of over $10 billion. Think Microsoft, Amazon, Tesla, and Alibaba. Mid-cap companies are valued between $2 billion and $10 billion, and then small cap are companies valued from $300 million to $2 billion. So large cap growth stocks were up 33% in 2024, while large cap value stocks were up 14%. Value stocks are companies like Nike, Pfizer, and Campbell Soup that are not going to fluctuate in price significantly, but will pay out a solid dividend. So while the return on these companies this past year was not as good, they also don't go up and down as much. As a whole, large cap investments were up 25% in 2024, while mid cap investments were up 15% and small caps were up 12%. Meanwhile, international markets delivered more modest results. Developed markets were up 4%, while emerging markets were up 8%. Here we see how different countries impacted the overall results of the foreign benchmarks. U.S. valuations have risen significantly over the past couple of years, with the S&P 500's price-to-earnings ratio now at 21.5x, above its 30-year average. What this means is that companies have a higher valuation relative to the amount of money that they are actually making. This signals optimism in the U.S. market, but it is also a function of the index's increasing weight towards fast-growing, more expensive tech and consumer-oriented companies. While we are still paying attention to valuations, we would note that valuations are not something that we look at to time the market, because valuations can remain high, i.e., stocks can remain expensive for longer stretches of time. Ultimately, higher valuations underscore the importance of diversification across sectors, regions, and asset classes as we move forward. In the world of bonds, while interest rates are still much higher than levels from 3 years ago, the Federal Reserve is slowly and cautiously in the process of trying to bring rates lower to help ease the early signs of a slowing labor market, while balancing the risks of a stubborn inflation fight. The yield curve remains only modestly inverted, signaling a cautious stance for 2025. Looking ahead, inflation's steady decline offers hope, but elevated valuations and market concentration highlight the need for balance. Diversifying across regions, sectors, and styles remains key. At Countess Wealth Management, we're here to help you navigate these opportunities and challenges. As always, we appreciate your business, but we value your trust. And I'll keep you posted.